Okay, welcome, Steve, to
Thank you.
this week 6 of our masterclass series. We are the Viterbi Startup Garage, Viterbi's incubator for USC, and we run the summer program. So everyone on this call, aside from maybe 1 or 2 people, are all students participating in that program, undergraduate, graduate students from the Viterbi School of Engineering. And everyone, this is Steve. Just a few little notes I jotted down, but then please, Steve, give yourself a much better intro than I can. He works on early stage startups for Amazon. He has some venture capital experience with Fintech teams. And he's had various positions at different Fintech organizations, including Yahoo and a company named Check. And my favorite part of your bio is that you went to Cal, because I'm actually a Cal alumni, so go Bears.
Go Bears.
Yeah, so take it away, Steve. I'm going to turn my video and mute myself, and it's just your show until you're done, and then we'll hit you with some questions afterwards.
Okay, great. Thank you for having me, and thanks for joining on today. Anyone who wants to go on video and ask a question along the way, don't hesitate. Sometimes it's a little hard to present to a bunch of faceless people online. So if you want to jump in, it's more than welcome. So what I thought I'd do today was look a little bit backwards and give you a little bit of kind of my background and how I got here. And then I think I'll walk you through the company that I helped build called Check. It's a Fintech, and some of my lessons learned there. And then I think we'll pause and shift directions and move towards the future and look forward and talk a little bit about the Fintech landscape and kind of why Fintechs are a little bit different than most startups. And I would also want to just kind of set the context a little bit that even if you're not a pure play Fintech, if you're an e-commerce company, if you're touching or moving or transacting in any way, shape, or form, you're going to touch Fintech in a way. So, there is this thesis kind of moving around in Fintech circles that every company is becoming a Fintech. So I think it's important to kind of keep that in mind, that you'll be dealing with transferring, moving money with customer data. And so there's a lot of lessons learned, I think, that every company can take away from Fintechs. Okay, so with that being said, let me talk a little bit about my background and how I got here. I'm a graduate of UC Davis. That's where I got my undergrad. I was interested in econometrics, and I ended up getting my first job out of college at a boutique management consulting firm where we built big databases and we applied statistical models and we tried to learn about pricing behavior and customer behavior. And I was able to kind of leverage a lot of interest around data and statistics. So that was my introduction into the business world. I found consulting to be a little bit too project oriented. And you'd go to a project for 3 to 6 months and then you'd move on to the next project. And being in Silicon Valley, I got the technology bug, and I really wanted to shift my career and focus on software specifically. And so I went to business school. I went to UC Berkeley, the Haas School, with really the intent of kind of moving my career into the software space. My first software job was at a company called Epiphany. I was a product manager. Being a product manager is a great place to learn a business. I learned everything about software really on the job. Epiphany was a marketing, analytics, and CRM company. We were really good at giving marketers kind of easy and simple to use tools so that they could segment their customers and run statistical models and target more effectively. And I found, though, that enterprise software at the time, the pace was a little bit slower than I really wanted. We had software development life cycles that were 12 to 18 months with maybe a minor release every 6 months. And my friends and coworkers or colleagues in other industries, particularly in consumer software, are just moving a lot faster. And so I switched over to consumer software to really pick up a really faster pace of product development. And I joined Yahoo. I joined the search team there and helped build out the real estate search engine. And so real estate was a little bit later to adopt online. We built listings online. We connected them to maps, and we gave a great user experience to primarily home buyers. But as part of that experience, we built out a lot of mortgage data and how to think about a mortgage and how to calculate, what your mortgage payment was going to be. And that was probably my first intro to online finance. With that, I got an opportunity to join the team at Yahoo Finance. And Yahoo Finance was really one of the largest financial kind of sites at the time. We served about 50 million uniques. Yahoo Finance is really market news and market data globally, and I was the GM of the North American business. So I learned a lot at Yahoo, and this is really where I started to connect the dots in fintech. Yahoo Finance was really one of the only kind of what I would call non-incumbent or non-bank or non-brokerage that had a sizable audience, and that was really delivering a user experience that was first based on what the customer wanted, kind of based on lots of data from lots of different places, an unbiased view into financial markets. And we partnered with every stock market exchange, most every financial news aggregator. And we really built this really great site for Wall Street folks, for day traders, but also just kind of Main Street investors. And I started seeing an opportunity in financial services to build experiences that started with the customer, kind of work backwards from there, and you didn't need to be a bank or a brokerage or an incumbent financial institution in order to deliver those experiences. And so I left Yahoo, and I spent the next 6 years of my career building a fintech company called Check. Check was, I would say, it's kind of mint.com meets Venmo. You could kind of track all your bank account, your credit cards, your bills. You can kind of see and track all your financial accounts at your various institutions, but then you could also make payments. And the payment area that we were focused on was bill payments. So you could pay your wireless bill or your utility bill or your rent, or if you were a family with kids and you had a piano teacher, you could pay your piano teacher. So we really tried to cover, kind of both the head and the tail of bills. So spent 6 years building that company. And then I transitioned after Check more into an investor/advisor role. So I worked at Amazon today, primarily working with Y Combinator companies as an advisor and mentor and helping them navigate Amazon AWS. And then I spend some of my time also with a venture capital firm called F Prime Capital. And F Prime Capital is backed by Fidelity Investments. I work on the fintech investment team there. And, so we see lots of early stage kind of financial services companies who are looking to get primarily their Series A or Series B kind of investment rounds. So anyway, that's kind of the long of my background and kind of how I got here. And what I want to do now is go a little bit deeper into Check. I'm going to share my screen and give you a bit of a timeline view into Check, and I think that might give you a better feel of kind of the experience that I went through and kind of how things played out at Check, and it'll lead me to talking about some of the lessons that I learned there. Can you see my screen? Can I just get somebody to give me a thumbs up?
I see, but I also see like the next slide. I see the presenter's screen.
I see. So let me go back, and I'll just get out of presentation mode, and I'll just go smaller here so you can have a bigger view of the screen. Is that better?
Yeah, that looks good.
Okay, cool. So let me just start off with a little bit about Check. This was a journey that started, roughly in 2007, early 2008. This is a very crude rendition of the timeline. No one ever hired me to be a designer, so I apologize in advance. But I think the point is made. Like everything on the top is kind of our evolution from an employee perspective, the amount of money we raised, and then kind of some key milestones. We launched Check originally as a company called Page Once, and Page Once was the original idea was to aggregate all of your accounts in a single place. The founder was frustrated with all the different passwords, usernames and passwords that we have, and he wanted to put it in one place and kind of connect to all these different accounts and deliver you a single user experience. And so this could have been your bank accounts, but it also could have been your Twitter account and your Facebook and your eBay account, your PayPal account, etc. And we built a technology that would allow you to connect all those places and aggregate all that information in one place. We launched initially as a Facebook app, ironically, and it failed. It failed like miserably. Like we launched this app, we were waiting for the customers to start using our fancy new aggregation application, and the reality is that no one came. And so this kind of will lead me to one of my lessons learned, but I'm going to kind of go through the whole timeline and kind of give you that context before we go into the lessons. But we had to pivot pretty quickly from like the initial kind of product launch. And luckily for us, at the back half of 2008, Apple launched the first generation App Store. And this seemed really promising to us. And so we quickly wrote, an application, had our developers really focus on building, kind of to the Apple specs. And we were in the first 200 apps on kind of the original Apple App Store. And this is kind of a key moment for us because, we were able to kind of ride that for basically for the next 6 years. We became a mobile only, when mobile only was novel. We were a mobile only application, and we got all of our customers through the app stores. So initially it was the Apple App Store, then it became the Android store, of course. But this was a key kind of timing mechanism for us as we jumped onto the App Store movement. We knew, or we felt strongly, that smartphones were going to be a big hit, and we could ride that wave, which we subsequently did. And within about a year and a half, we had 1 million users on the platform. And this allowed us to raise kind of our first kind of institutional round of capital, which was about $6.5 million. Something we noticed during the pitch process for the $6.5 million was that we got a lot of feedback that we were trying to be kind of all things to all people. And what we noticed was that our users were really engaging more deeply on financial services. So people were connecting their credit cards, they were connecting their bank accounts, they were connecting their bills. And these users tended to use the platform more, use the application more, were much more engaged, and kind of stuck with us longer. And so we made a decision in 2010 to pivot into financial services squarely and kind of get rid of all the noise outside of financial services and really be a financial services application. So we built a mobile app that was squarely focused on track your bank account, track your credit cards, connect all your bills, and be this single place where you can get a handle on your financial life, and all through the convenience of your mobile device that's always with you. And so this value proposition worked quite well. We were Apple's 2011, or one of Apple's 2011 App of the Year. I think we were also one of the 2012 Apps of the Year. We were an Android editor's choice. So we got a lot of attention in the app stores, which was our primary kind of acquisition channel. That helped us get to about $15 million of investment in the next round. So we continued to build our customer base, build out our product, and we raised a next round of $15 million. This coming from Canvas Ventures in Silicon Valley. During that pitch, and I think that, you know, because as we went to investors to kind of articulate what we thought our future was, our next move was really adding in what we felt was kind of our next phase, which was payments. And we integrated payments into the mobile application to make check much more actionable. So kind of read-only applications only take you so far. They're useful, but after a while, if you can't do things in them, we felt like we would lose customers over time. And we felt payments was a much more engaging, action-oriented utility to implement into the application. And so we embarked on a multi-year process of integrated payments and building up a payments engine inside of Check. As I mentioned before, we focused on bill payment. So we were very squarely focused on, hey, this is a very convenient and easy way to pay your utility bills, pay your mobile bill, pay your credit card, pay your mortgage, pay your local bills like your nanny or your piano teacher or your gardener or your school. And so we really wanted to be that kind of central utility for people to track their cash and pay their bills. And this also worked quite well. We were able to leverage the existing user base, and in about a year and a half or so, we were processing about $1 million of payments per day. And that would ultimately go to $2 to $3 million per day of payment volume. And so we were able to quickly build a pretty robust payment engine. This led us to raising more money, which was the $24 million round at the end of 2014 that we raised. And at that point, we had about 10 million consumers. We were page once this entire time. And for a long time, and I'm going to have a lesson learned on this, is we were really bothered by this name because we didn't think it was very reflective of what we did. And so we spent most of 2012 basically coming up with a new brand and a new name, and we renamed the company to Check. So that really helped us, I think, from a consumer perspective, and also raise that next round. And I think the final kind of part of this evolution is ultimately our acquisition by Intuit. For those of you who don't know Intuit, Intuit's the maker of TurboTax and QuickBooks. TurboTax is the dominant tax preparation software for consumers, and QuickBooks is really the dominant small business accounting platform. I view Intuit as really one of the original fintechs, and so we were fortunate to be acquired by Intuit and have Check ingested into Intuit to integrate into Mint and integrate into different parts of Intuit to make their financial experiences better. So that's kind of the Check experience. I'm going to pause there and see if there's any questions, just anything that comes to mind, so that I don't just continue to dominate the airwaves here. Any questions?
Sure, I have a question. So, as you guys were kind of evolving as a company and wanting to be all things to all people, who were your major competitors at that time?
Yeah, great question. In the beginning, when we were all things to all people, we were pretty unique in the App Store, and I think that helped us get some traction. it's a funny story is when we originally listed our name in the Apple App Store, we actually put an A before page once so that we could be listed first, because they were so like rudimentary at the time that they listed things alphabetically when there were only a couple hundred apps in the App Store. So we were very unique in the beginning, but then as we evolved, there became travel apps that focused on your travel accounts. There became, shopping apps that focused on your shopping accounts. There became banking apps that focused on just your banking. And so we didn't feel that, kind of as the App Store got more sophisticated and there were much more categories, we didn't feel that we could sustain without focus. And that's why we pivoted to financial services. And ultimately in financial services, we were competing with banks on one hand, who could only provide, their experience. So if you were a Bank of America customer, you could just get Bank of America information on the Bank of America app. But if you also had an Amex card and a Cap One card, you had to go download those apps. So we were this aggregation layer on top that could kind of pull in all your different financial accounts into one place. And then, kind of ultimately we competed with, other payment vendors, right, who were providing payments to merchants and to payments to billers. So lots of B2B players in that space, but also PayPal, Venmo, kind of your kind of typical kind of P2P consumer applications also were in our competitive space. Hope that answered your question.
Yeah, that was great. That was great.
Okay.
Cool. One more question.
Yeah.
It seems like a good portion of your user base was B2C, like a consumer. It was like mostly a consumer app. Did you guys have any interest in being a B2B financial solution, and then just kind of decide, let's not do too many things and focus on consumers? Or like, what was the thought process there?
Yeah. That's a great question. We were focused exclusively on consumers for 2008 to 2013. That was, kind of our primary focus was building a great consumer app, allowing consumers to find our application in all the places that they were going. So, but I think and I think that helped us focus. Over time, though, as we got more established and more mature, around the end of 2013 and in 2014, we started creating a B2B kind of side of Check, which was we would sell Check software into billers and to merchants so that we could handle their payment volume, be their mobile application of choice, and we would actually make money by selling software and services into kind of let's call it the endpoints where we sent money. So I would, kind of that's always a trade-off, kind of B2B, B2C. I think early stages of a company, you should focus. As we evolved and expanded our business model, we were able to kind of do both. Does that answer your question?
Yeah, that was perfect. Thank you.
Cool. Well, look, I wanted to spend a little bit more time walking you all through what I consider kind of my 5 lessons learned. And this was kind of fun to go back through and really think about these things. But I wanted to share these things because I think about them kind of all the time. And the first one that I wanted to mention was when you're creating a company, I think it's really, really important to think about the thing that's bigger than you. Because you're a small startup and you don't have a loud voice and you're just, trying to execute on small tactics in the beginning and just get things off the ground. But it's really important to have, let's say, wind behind your back or some sort of bigger wave that you can attach to. And I think I mentioned it early on in our kind of timeline review, is that Check, I think one of the reasons we were successful, and this is not necessarily a fintech thing, this is, I think, for any early stage company, one of the reasons we were successful is we were able to attach ourselves to a wave of mobile innovation. So there was a very significant shift of consumer attention away from PCs, laptops, and onto mobile devices. And that was happening kind of with or without check. And we just happened to attach ourselves to it and kind of ride that wave. And I think that was a big part of our success and successes I've seen in other startups is they're able to identify kind of a macro trend or macro wave that's significant and build their company based on that. So we started off in the Apple App Store, and that led us to Android, and that really helped kind of get us off the ground and drive growth in the company without having to spend tens of millions of dollars in order to acquire consumers. So what's bigger? What's the thing bigger than you? And I would really encourage you, as you think about business plans or companies you're thinking about, to think hard about this particular point. The second thing was mobile payments. We jumped on the mobile payments wave pretty early. People weren't super comfortable transacting on mobile, but they also weren't super comfortable transacting way back when on the web. But we knew it would come. We knew that as mobile devices penetrated into people's lives further and further, that transactions, commerce, transacting with your bank accounts and credit cards would be something that would be significant. And so we attached ourselves second to that kind of mobile wave or mobile payments wave. And so I think we did two things right is on this first lesson. I think the first one was more important, but the second one I think kept our growth going and kind of gave us another boost along the way. Second lesson for any startup, and this is always kind of difficult to tell early stage startups or founders, is that you will pivot. Almost everyone does. It's very difficult to kind of come up with an idea in a vacuum, go out to market and kind of stick with that original idea. And so you will pivot in some way, shape, or form. And I think my main lesson was make that count. Kind of really be thoughtful about, where you're going to pivot to and why, and bet on it. And I think we did that in financial services. We saw our users really gravitating towards the banking and credit card and bills kind of components of our application. And that gave us the clues and the confidence to make that pivot and really dive in the pool with 2 feet in financial services. So you will pivot, and you got to just make sure it counts, because you don't have too many opportunities to make those pivots. Lesson number 3, and this one we didn't discuss in the timeline, but that is what do you stand for, and to kind of defining your values early. This is always kind of hard for early stage founders to, take to heart. But I think we learned the hard way, I think, at Check, that this is important to do really early on, because it sets the foundation for almost everything you do internally inside the company. So if you have values, you know how to hire the right people, because those people will share your values. If you have values, the people that you hire will know how to behave kind of internally, so that you can operate the company well. If you have values, kind of act with customers and how to, act with partners, because you have this foundation and you know which partners and which customers you want to serve. And I would highly encourage any early founders to kind of write this down and put it on paper, because just kind of going back to our timeline, we were a little late on this. And when we grew between 20 and 50 employees is really when things start to get more complicated inside of a company, and where values actually end up mattering in how you make decisions internally. So I would highly encourage you to do that early. I work at Amazon now, and so and Amazon has published leadership principles, which I think are outstanding, and I would encourage you to go look at those, because those are really, I think, a very good example of a company that set values really early and has stuck by those, and the employees inside of Amazon really embody them. Lesson number 4 is that names matter, and you should try to get it right from the beginning because we got it wrong. We called ourselves Page Once. It's not a very good name. It's not very memorable, and it didn't really reflect what who we were and what we did. And our founder tells this funny story about, he was an engineer by training, and I just didn't think this area was just not his strong suit. So at the time, he named the company based on the cheapest URL that he could get. I think it was like $9.99, and so he got pageonce.com, and so he was satisfied with that name. But I think if you're building a consumer brand, you need to be a little bit more thoughtful about it. And so when we changed our name to Check, I mean, it was just such a big difference in kind of our consumer messaging and our brand and really what we stood for. And it made a connection to what we did, which was manage all of your different accounts and then make payments. So the name matters, get it right from the beginning, and don't settle early on is the lesson there. And then finally, timing is everything. And so I've gotten a much bigger appreciation for timing. We timed the app stores. This was a really important kind of fork in the road for our company. We timed mobile payments. And so I think, like, don't underestimate, is the problem that you're trying to solve, is now the right time to solve it? Are there the right technology components? Is the consumer ready? Is there a business model? You can be too early on certain ideas, and it's good to be patient and wait for those ideas and the markets to materialize so that you can build a sustainable business. And so I would part you with my final lesson, which is timing is everything. I'm going to pause there and take any questions, and then we'll look at kind of the future of fintech.
I have some gardening going on outside, so I apologize if you guys hear any of that. Before I start asking all of my questions, because I definitely have some, I want to give students a chance to ask questions. Anyone out there?
Don't be shy.
I know, right? Do not be shy. Okay, I'll start. My first question is, so you were mentioning kind of the bigger than you like innovation wave that you can ride that will help put the air in your sales. And I'm wondering now, since you have so much experience with Y Combinator, which is a pretty premier accelerator, and then you're also doing some investment and stuff, are you like seeing any waves, like any new innovation waves that we should look out for, that people can kind of latch onto and ride?
Yeah, that's a great question, and thank you for asking it. Because there's more waves than just mobile apps and payments. Cloud computing is a significant wave, and we're still this is going to be kind of a multi-decade wave, in my opinion, and we're still kind of in the beginning of cloud computing. And so I think tools that sit on top of cloud computing is a pretty significant wave to kind of attach yourself to. I can't imagine a future, let's say 10 years from now, where we still have, massive server farms being run by third parties or that are being run by yourself, right? So I think all of those will go away. We'll continue to kind of be on several cloud computing platforms. And I think that's a pretty significant wave to attach yourself to. I think kind of more, kind of a recent phenomenon wave is, frankly, COVID-19 is a wave. We're seeing, a pretty significant level of investment in both in the biotech space, which is lots of companies trying to solve, kind of more on the science side of things, but trying to solve problems when it comes to pandemics. So we're seeing a lot of it in biotech. And then second, we're seeing a lot in remote tools and video, and how to kind of navigate this new world where we're all kind of at home dealing with each other over video conferencing. So two very significant waves that I think are here to stay.
Yeah, I feel like you're hearing a lot, especially on the news, kind of these repetitive issues that, different thought groups are trying to wrap their head around. For instance, like every day I'm hearing more about education and how we're going to continue education remote,
Yeah.
and how teachers and schools and, in terms of public and private university, all the way down to grade school, like there's a big issue there and no one's prepared. So and that's just one problem that
it's just one sector. And I would argue that we've been in kind of an ed tech wave for some time. It's just been a really slow developing wave. And what this kind of pandemic has done is shot it in the arm, really, to really kind of accelerate it. And so we're seeing a lot of activity in kind of the combination of education software and remote learning, kind of remote tools. It's an area where we're seeing companies apply new technologies, but then they're being heard a little bit sooner, a little bit faster, with a little bit more attention, and not kind of, hey, we can talk about that next year.
Yeah, I feel like ed tech adoption is a very slow moving.
Yeah.
Technical.
But for sure, I think this is going to accelerate it.
Yeah. My next, does anyone else have a question before I keep going on with my questions? Speak now. My next question is with regards to pivoting, how you're saying basically get ready to pivot, you're going to end up pivoting. It can be pretty precarious to pivot. So I'm just wondering, do you have like a pivoting word of caution, like having done it yourself? Like, are there like cyanide pills to pivoting, things that you like absolutely should never do when you pivot?
Yeah. I think a couple things. You don't pivot quickly. You give it a lot of thought. You prepare a plan. You put the research into it. You soundboard it on as many advisors, investors as possible, and you kind of work the plan to see if it's the right thing. Because I don't think you pivot into something hastily, because these are serious decisions. So I think any pivots that are hasty, I would recommend against. They're pretty significant events or decisions that you make inside the company.
And then my last question, which is my favorite question, because I do think that this is really just like the life's blood of everything that we do, is this kind of company values and company culture and how we hire, how we lead. I'm wondering, like, based off of your experience, like what would you consider kind of your top shelf company values that like every company should have as a value at the top from your experience?
Yeah. I mean, I think there can't really be values without talking about your customer first. So I think that, most companies will kind of put their values into kind of different dimensions or categories. And I think it has to start with, well, who are we to the customer, right? What value do we bring to the customer? How are we going to orient ourselves to serve this customer? And how do we make that a core value inside of the company, so that everyone inside the company, no matter who you hire, what part of the company they're in, really cares about the customer. And I think that is probably the one area that if every company could drop every value but keep one, they would keep the one that serves their customer, because that's ultimately what's going to serve them long term.
Wow, that's an amazing answer. I've actually never heard anyone say that before. Have any more questions? That's my last question based off of what you just did right now. Anyone have any additional questions right now before we move on? Okay.
Cool. If you come up with something, just don't hesitate to interrupt. Time check. How are we doing on time here?
We are at 43, so we have about 15 more minutes.
Okay, perfect. So
we can also just
shift.
Never mind. Continue.
Let's shift gears and talk about the future of fintech, and I wanted to provide a high level landscape of the different types of categories, what they mean. I think there's actually some missing categories in this one, although I have a lot of respect for CB Insights and the fintech coverage that they provide. But I wanted to kind of walk through the different types of fintechs and how you all might be engaged with them or how they might impact your business. So of course, lending is kind of a tried and true fintech model, right? That is the primary business model of most consumer and commercial banks, right? So they're taking in deposits, they're aggregating those deposits, and then they're lending, either directly to consumers or to small businesses or commercial entities. So lending, whether you're a fintech or you're another type of company, at some point you'll either be on one side or the other of lending. And I think where where there's been the innovation in lending has been in data sets. So using data to underwrite particular borrowers in new and innovative ways. So banks have traditionally had a very static lending underwriting model, and where you've seen fintechs kind of come in here is with new types of data that were previously not available or unexposed that actually matter when it comes to making an underwriting decision. And so data has really been, I think, the key innovation on the lending front. Blockchain and crypto, you're probably familiar with to some extent. These two things, although they're quite separate, tend to get lumped together in the same bucket. Blockchain really being a distributed data technology, where crypto is really, kind of an alternative form of currency. So these have obviously been pretty significant over the last, let's say, 5 to 10 years. Lots of startups in this space. Has been challenging for most to find the business models, but I do think that there is a kind of long-term. I think there is a long-term play for alternative currencies, and I think there's a long-term play for blockchain technology. But it's really kind of finding, kind of today's business models that can benefit from those that people are going to pay for. And so I think we're still trying to find those. RegTech is something that most fintechs have to deal with. They're highly regulated industries, and depending on which part of the world you live in, there's different types of regulation, and depending on what type of industry you're in, there's different types of regulation. And so RegTech companies are trying to automate and codify a lot of what's going on in the regulatory framework, so that it's not a manual review, it's not a manual process, but you can really integrate it into your operations and be compliant along the way. Personal finance is an area that I obviously have spent a lot of time in at Check, and these are savings applications, aggregation applications that I find there's no budgeting applications. There's no lack of any of these. I think traditionally it's been a hard market to monetize. And so finding, some combination of personal finance and maybe some other part of fintech, I think is important, of which Check did. We were very much in the payments and billing and personal finance space. Payments is almost everyone who's starting a technology company will have to deal with, because you'll be either processing orders, collecting data, working with third parties who can help you process over credit card or debit card rails. I think this is an area that will continue to see innovation, and particularly what I like to see is kind of combinations of payment type companies, but integrated into some other workflows. So, F Prime, for example, is invested in a company called Toast. Toast is a restaurant POS system. It has integrated payments, but it's also an expert in the workflows that a restaurant has to go to book reservations, take orders, and then process the ultimate bill that you get at the restaurant. So interesting opportunities, I think, around kind of workflow software with integrated payments. Insurance has been pretty significant market the past 5 years. Companies finding new ways to underwrite, making it easier for small businesses and consumers to get insurance. Or any of you who have insurance, shopping for it is not the most gratifying experience. Capital markets is really kind of dealing with kind of anything around investments or wealth management and kind of the tools that support it. So I at Yahoo Finance, I was pretty involved in this market. We've had the rise of robo investors, but there's also lots of kind of tools that support the investment community. So whether it's for capital market platforms for traders that bring in new types of data, allow them to do trades on the back end, and I think there's lots of interesting areas around wealth management. Money transfer is kind of gets its own category. It's a lot like payments, but because you're transacting across borders, it has some extra special characteristics to it. So, TransferWise is a very good example of a company in the international remittance area. F Prime is an investor in Flywire. Flywire is, the leading platform for students to remit payments, and it has a component of allowing international students to make payments to any school that they're going to around the country. And so international remittance tends to kind of be its own category. And then, of course, there's mortgage and real estate. I always find real estate to be a close cousin of fintech, now called its own category called prop tech. So that is an area where we're continuing to see data kind of explode for allowing consumers to help make them better decisions around buying and selling real estate and getting the best mortgage. One area that I think is kind of not in here, where there's pretty significant, there's been some pretty significant companies, which is just data. So maybe somewhere in the middle here, there are a bunch of data platforms that have done a really great job of aggregating financial data, whether it's from a bank or a credit card, a mortgage company, but they kind of provide the data that powers a lot of the fintech economy. I think Plaid is really at the forefront of the data economy and fintech and financial services, and we've seen a number of kind of other data companies. So to the extent that a data set is valuable and it hasn't been exposed, or it's hard for people to access it in any kind of normalized fashion, we're very bullish from a fintech investment perspective on data platforms that can help companies add more and kind of richer data to their decisions. So I think that's kind of a category that's missing here. Fintechs. So this is obviously a broad landscape, but like fintechs are pretty different than most because of the regulation that most fintechs are subject to. So if you're starting a new bank, you're going to be regulated just like an existing bank, and so you've got to go through regular audits. You have to collect and store and transmit data in a compliant way, and there's a lot of, I would call, tax on top of fintechs in order to be compliant, and it's pretty serious and should be taken serious by any fintech. That's kind of unique point number one. Number two is it takes a lot of time to build trust with customers in fintech. I mean, just kind of think about yourselves when you're kind of dealing with anything money. You want to make sure that the service that you're using is going to calculate things correctly, is going to transfer money properly, is going to be compliant, and there's really no risk in the system that you're going to be surprised by. So trust is challenging to build. It takes time, and I would say fintech is not an industry that you can build products in what I would call kind of hack and break things. which is a very common development model, to just be aggressive about building your product, and you're going to take roads that are going to break things, and then you're going to fix those and make your product better. Fintech is just not one where that model is very conducive. You really need to earn trust. It's got to work, from the get-go. You kind of can't have products that work halfway, and you've got to really take that seriously, because if you don't, you're going to not earn the trust of the customer, and you're not going to be able to keep them. And so, because of the regulation, and because of the time it takes to earn trust, it just takes more time to build these companies. And because it takes more time, it takes more capital. And so the fintechs tend to be more capital intensive in general. It takes companies 10 to 15 years to really build into a material company. There's only been a few fintechs that we've seen go public, and it's taken those fintechs pretty significant capital to get there. So I personally love it because you can have a lot of impact on a lot of people, but you really have to be in it for the long haul to make it. I would say Check, our journey was about 7 years, and in general, I would say it was shorter on average than most other kind of successful fintechs. So with that, I'm going to pause and kind of take questions about areas of interest in fintech, and maybe some of the areas that F Prime is looking to invest in, or things that I see in the marketplace.
If you don't mind, can I just double back really fast on your number 8 slide? And
yeah.
So this is a real personal problem of mine that I'm just wondering if you're hearing anything being, built, or if there's any innovation in this space. I would imagine it falls under the insurance category, but I feel like there's no real good consumer-facing health insurance financial support platform. And I know that just in general, even now with the pandemic, it's very clear that hospitals themselves are not very interconnected when it comes to data, and then insurance is even worse. Sometimes it feels like I'm talking to 3 completely different worlds, like the doctor, the hospital, my insurance company, and so often they all get it wrong. And then I have to spend hours solving that problem with very little visibility into what exactly is going on. And I'm just wondering, is anyone going to solve this problem? Will there be consumer facing, like the way that you kind of aggregate bank data for a consumer, like health insurance data and co-payments, deductibles, so that you can see what you're working with?
Yeah.
Health insurance.
It's an excellent question, because it's an area that we specifically focus on at F Prime. We make a lot of healthcare investments, we make a lot of fintech investments, and I also see it on the Amazon side. We've got just this incredible team that really helps solve problems with healthcare companies, and the area that is kind of lacking in innovation is really the data. There's not a consistent set of data standards yet, kind of across, let's say, kind of billing, insurance, diagnostics, kind of the customer information. Many things are kept in silos at different entities, which is probably leading to many of your crazy customer experiences. And so, yes, I think this is an area of opportunity, but it's really going to take some fundamental change at the kind of the data platform level. So I've always viewed that there's not always, but like I've viewed that we need like a plaid for healthcare that can kind of make sense of all the different data sets that are underneath and tie them all together into a single place.
Great. I mean, I'm just very hopeful that in my lifetime this will be resolved.
Likewise.
The next question is just talking about liability. I feel like a fintech team, based off the fact that you're working with the finances of other businesses and people, that there's a great more deal of financial liability on your shoulders as a startup, but maybe that's not true. Maybe if you put enough in the fine print, you can protect yourself. Or do you as a startup have to pay money, some of your capital to protect your company from kind of what you were saying, like a lukewarm entrance where you're not solving all problems and maybe you make some mistakes along the way and it costs your customer.
Right.
Are there dangers to that in fintech specifically?
There's costs in fintech that you need to kind of, make sure that you're spending money to go kind of deal with these issues. So first off, I'm not a lawyer, so you have to get kind of legal advice here. But fintechs do have kind of an extra burden to go through in order to set up their systems in a way and their processes and procedures in a way so that the consumer or the end customer is protected. So I'll give a very short example. If you're a payments company and you're collecting money from a consumer and you're sending it downstream to a merchant or a biller or just an endpoint, you can't mix that consumer's money with your operating budget to run your company, salaries, payroll, expenses. So what you end up having to do is you create trust accounts or separate regulated accounts where only the money goes into that regulated account. It has a trustee, and that money cannot be intermingled, for example, with the operating account of the company. So you've got to set up multiple bank accounts. You have to set up the processes and procedures, and you got to document it all so that you're compliant and legal, and you're not intermixing your operation with the customer's money. So there's a lot of extra steps that you have to go through in order to protect the customer. And then, again, most companies are setting up as a C Corp. They're setting those up. The C Corps have, kind of the reason they exist is to protect, kind of founders, employees from personal liability. And so you're definitely going to want to spend time with an attorney to make sure you have kind of the proper setup of your corporation before you open it up to end users.
Cool. I mean, I have a million more questions. We're right at the end of our time though. So I want to just once again open up for the group. If you guys have any questions for Steve before we say goodbye to him, and thank you so much for all of his help. Anyone? Anyone from Pocket CFO have any questions? Seems like
it's a quiet Monday.
Well, I would just like to once again thank you. This was really insightful, not just in terms of fintech. I feel like you have a really good bead on just startups in general. I've been working at the Garage for almost 2 years, and I hear a lot from different people in different kind of worlds, the VC, the startup, the founder, the, industry specialists. And I feel like some of the things that you shared with us were pretty unique and really powerful. So thank you so much for sharing and for coming out.
Cool. Glad to do it. And if anyone has any follow-ups or wants to get in touch with me, you have my contact information, so don't hesitate.
Yeah, perfect. Thank you. I'm sure the students will take advantage of that. I hope you have a good rest of your Monday. Thanks again. Bye, everyone. We'll see you on Storytelling Wednesday.
Okay. Take care. Thanks so much.
Bye. Thank you.